Are index funds a better investment than ETFs? In this video, we're diving deep into the world of investing, answering the burning question, are index funds a better investment than ETFs? We'll break down the differences between these two investment options, helping you make a smart financial decision. You'll discover the pros and cons, understand how they work, and learn the key distinctions that set them apart. By the end of this video, you'll be well equipped to choose the investment path that suits your needs. So let's unravel the mysteries of index funds and ETFs and get on the road to financial success. Hey there, have you ever found yourself in the confusing world of investing, hearing terms like ETF, index funds, and mutual funds being thrown around like jargon soup? It happens to the best of us. You see, people often use these terms interchangeably, causing a lot of confusion. But what if we told you that understanding the differences between these two could be the key to unlocking your financial success? In this video, we're about to unravel the mystery behind ETF, index funds, and mutual funds, helping you untangle the web of pros and cons that come with them. We'll break it down into bite-sized pieces so that by the end of this journey, you'll confidently know which investment option is tailor-made for you. So, are you ready to dive into the world of smart investing and discover the financial path that suits you best? Let's begin with the basics of buying shares. There are two main ways to do this. One way is to purchase individual shares. For instance, if you're interested in companies like Apple, Amazon, or Tesla, you can buy their shares directly from each of these companies. However, if you're looking to invest in a variety of different companies, buying individual shares can become quite complicated. You'd have to make numerous separate transactions, place many orders, and pay fees each time you buy. Instead, there's a simpler approach, investing in a fund. When you invest in a fund, you're essentially buying a collection of shares from various companies all at once. This provides you with diversification, which means you're spreading your investment across many different companies. So if one of them doesn't perform well, it won't have a big impact because it only represents a small part of your overall investment portfolio. Now that you understand how individual shares and funds work, let's dive into the next level, where we explore different kinds of funds. There are two main types to know: actively managed funds and passively managed funds. Actively managed funds are pretty straightforward. These funds are actively taken care of by an investment expert. In other words, when you invest your money in such a fund, there's a professional who's making decisions about which stocks the fund should have. Their goal is to do better than the overall market, aiming for higher returns than the market average. Investing in a fund where experts actively manage your money can be a good choice because it's convenient. You don't have to worry about picking individual stocks, it's all taken care of in one go. But here's the catch. These funds can be costly because you're paying for the expert's work. And here's the surprising part. Most of the time, these expert-managed funds don't do better than the regular market, especially when you factor in their fees. Hey, before we continue, we want you to know that we're always making new content, so make sure you like and subscribe to our channel so you don't miss anything. Now let's talk about the alternative, which is passively managed funds. These funds don't need an expert to make decisions. Instead, they follow a fixed plan and copy an index. So if you're looking for a simpler, less expensive option, passively managed funds like index funds and ETFs, exchange-traded funds, might be the way to go. They give you a more hands-off approach to investing. Now let's talk about the index. Imagine an index as a kind of list, but this list groups companies together based on something they have in common. They might be grouped by the type of business they do, like companies in the energy field, or they can be grouped by how big they are compared to others, both in their own country and around the world. For instance, you might have heard of the S&P 500 and the FTSE 100. These are famous indexes. The S&P 500 is like a team of the 500 largest companies in the United States, while the FTSE 100 represents the top companies listed on the London Stock Exchange. You can't directly invest in these indexes, but you can put your money into something called an index fund or an ETF. These are like special investment tools that let you invest in a bunch of companies, kind of like a mini version of a specific index. You can see when you invest in funds that follow certain lists of companies like the S&P 500, you can save money and fees. These lists aren't fixed. They're managed by groups of people who pick companies based on specific rules. Let's take the S&P 500 as an example. There's a committee that decides what a company must have to be one of the top 500 in the US, like being a certain size or having enough shares trading, but these lists change. If a company no longer meets the rules, it gets kicked out, and a new one takes its place. For instance, recently DXC Technology left the S&P 500 because it didn't meet the criteria anymore. A different company replaced it. So when these changes happen, funds that try to copy the list's performance also adjust what they hold. They want to match the list's performance as closely as they can. This means the fund's performance should be going up by about 4%. In simple terms, these funds and ETFs are like trackers. They help us invest in lots of companies from the list, so we can try to get the same results as the whole list. Now, let's explore the similarities between two types of investments: index funds and ETFs. These investments share some common traits that make them appealing to many people. Firstly, both index funds and ETFs are cost-effective. This is because there isn't a team of experts actively choosing which companies to invest in. Instead, they follow a predefined index, essentially a specific list of companies. Secondly, they both aim to replicate the performance of the chosen index, so when the index does well, your investment does well, and when it doesn't, your investment follows suit. Another similarity is diversification. With these investments, you can spread your money across many different companies at once. This can help reduce risk because you're not putting all your eggs in one basket. Lastly, they typically provide returns that are in line with the overall market or a specific sector. In other words, you can expect average market returns by investing in them. So in a nutshell, both index funds and ETFs offer low costs, mirror index performance, provide diversification, and yield market-like returns. This makes them attractive options for investors looking for simplicity and efficiency. What sets ETFs apart from the index funds? Well, one key difference is that ETFs can be traded all day long, making them a bit like a mix between stocks and index funds. You have the flexibility to buy and sell them whenever you like, and their prices change throughout the day. On the other side, index funds set their prices just once at the end of the trading day, so whether you buy an index fund in the morning or the afternoon, you'll get the same price. Another distinction is the initial investment. Typically, you might need to put in a larger amount to get started with an index fund. ETFs, on the other hand, let you begin with just one share, which can be much more affordable. Hey there, before we reveal the other perk of investing in this fund, make sure to tap that subscribe button and turn on the notification bell. This way you won't miss out on our newest videos. You can decide if you want notifications for just a few videos or all of them. It's your choice, and if you're using your phone, don't forget to enable notifications in your settings. Lastly, there's the option of automatic investing. Many index funds allow you to set up regular contributions where a set amount is automatically invested at intervals you choose, like monthly or quarterly. This makes it super convenient for consistent saving and investing, taking away the hassle of doing it manually. While some investment platforms offer similar features for ETFs, it's more common as a feature for index funds. So let's break it down with an example. Think of a famous type of investment called the Vanguard S&P 500 ETF. Vanguard is the company that made this investment option. Just like Vanguard, there are other companies such as iShares offering similar choices. Now, the S&P 500 is the name of the group of companies this investment follows. It's like a list of top companies, and the ETF is the name for the kind of investment you're getting into. It's a simple way to invest. Now, when you see UCITS, it's like a stamp that says this investment is checked and good to go for Europe. It's ready to be traded in Europe, making it convenient for European investors. So you have options to choose from like Vanguard, iShares, and more, and these investments are designed to follow groups of successful companies, making it easy for you to invest in Europe. As we wrap up our journey through the world of investing in ETF index funds and mutual funds, let's reflect on what we've learned. Understanding these financial tools can be the key to unlocking your financial success, and it doesn't have to be as confusing as it may seem at first. So which type of investment suits your financial goals better? And are you ready to take the next step towards a more secure financial future? Are you inclined towards a hands-off approach with low costs and market-like returns, making ETFs and index funds your go-to choice? Or do you prefer the convenience and guidance provided by actively managed mutual funds, even if they come with a slightly higher cost? Let us know in the comments section below. And as always, don't forget to hit that like button if you found this video helpful, and subscribe to our channel so you don't miss out on my latest content. And for more resources and links related to today's topics, be sure to check out the description below. Thank you for watching, and we'll look forward to reading your comments and engaging with you in the next video.